Hi, I'm Akshat Malhotra. This is not just a standalone video, but a part of an entire course on the fundamentals of personal finance. All the videos so far covered everything you needed to know to set your basics and even understand the various financial avenues that are available to invest. Now, this particular module will cover diversification and financial planning in depth. Now, I hope you all agree with me on how important diversification is. But I'm sure there's one question that's coming into your minds now. Akshat, how do we go about diversifying our money? How much to put into fixed deposits? How much to put into real estate? How much to put in gold? How much to put in equity? How do we go about actually calculating that? Should we just put like 25% each in each of them? Or should we actually calculate particular weightage of each of these? So yes, there are actually calculations that go behind coming finally onto a plan as to how much should you particularly invest into equity versus fixed income versus gold. But before we do that, let's understand what are the bases of deciding how do we go about dividing our money into each of these. And I have this framework that we've prepared, which we feel is very, very solid, which could act as a pillar of your complete financial planning. And these three pillars are the goal that you have in mind for which you want to save money or invest money, the time in hand that you have in order to achieve that goal, and finally, the risk appetite you have in order to fulfill that financial goal. Let's understand each of these in detail, and then I'm sure you'll realize why each of these is important. Let's talk about goal first. Goal-based investing. I'm sure you would have heard of this word these days. Goal-based investing states that instead of thinking about a bottom-up approach, that let me start with investing 2,000 rupees a month so that I can create some corpus in the future after 5 years, 10 years. Instead of thinking about investing your money that way, why don't we think about a goal for which we need to invest our money? Let's say for example, I want to buy a Honda City car in 5 years from now. So I have a goal in mind. I have associated that with a time, and I know how much Honda City would cost me. And so using that, I deduce to a number that I need to start investing or start saving this amount of money in order to make sure that I'm able to buy a Honda City in 5 years. This is called SMART goals. SMART stands for specific, measurable, actionable, realistic, and time horizon driven. Now with this example that I took, I want to buy a Honda City in 5 years. Is it specific? Yes, it is specific. I need to buy a Honda City. Is it measurable? Yes, I can measure it. It's about 15-16 lakh rupees in price. Is it realistic? Yes, it is realistic. Honda City does exist. I'm not trying to buy something which doesn't even exist. I'm not saying I want to buy an island. It exists, but then a little not realistic. Is it actionable? Yes, it is actionable because I actually can start investing or saving for it so that I can buy it. And then I've associated that to a time horizon. I've given myself 5 years of time so that I can save enough in order to achieve, fulfill that goal. So the first pillar of financial planning is goals, setting your goals, goal-based investing. We need to associate ourselves. We need to think about the goals that we have in life. Could be, again, buying something that we need to, about saving for, let's say, our children's education, saving for our own higher education, saving for children's wedding, saving for our wedding. These are few of the common goals which are there across the board, right? And that's why I'm naming these. But it could be something else as well. Maybe starting up a business, buying a laptop, buying a camera, right? So the point is that anything that we want to do in life, any of the financial goals that we want to fulfill in life, we must write all of them down and then make a plan in order to achieve those goals. So that's number one, goal-based investing. Number two pillar is about the time that I have in hand. How much time do I have in hand in order to fulfill that goal? Let's say I'm about, let's say I'm saving for my daughter's education, and she's about 5 years of age right now. I want to save for her higher education. So I have about 10 years, 15 years of time, right? So that defines the time that I have in order to achieve that goal. Similarly, another scenario could be that my daughter is already in class 10th, and she has about 2 or 3 years to go for a higher study. So in this case, I just have 3 years to achieve this goal. So the point being that each of the goals, and similar to what the T in the SMART stood for, the goal should be associated to a time. We shouldn't say that I want to buy a Honda City. Let me see, maybe after 10 years, maybe after 5 years, maybe in a 3 years time. No. Got to be specific. So associate a time to your goal, number two. And finally, number three, a concept about risk appetite, the risk capacity. How much risk am I willing to take with my money in order to achieve that goal? Somebody can take a lot of risk, somebody can maybe not take too much of risk. And to understand this, let's play a small game. And please play this along with me, because that's going to be the fun. So let's say you have 1 lakh rupees, okay? And you have just 1 lakh rupees, nothing more. You just have 1 lakh rupees with you as of today, and you want to invest that money somewhere. So you choose a financial avenue, you do your analysis, and you put in 1 lakh rupees into that particular financial avenue. You don't have more money, just 1 lakh. Now, 2 months later, something happened and the value of that 1 lakh rupees is about 80,000 rupees. Now, at this point of time, ask yourself, if your 1 lakh rupees actually drops down to 80,000 rupees, are you going to withdraw your money, or are you going to wait for it to, maybe come back? Are you going to be hopeful with it that that's okay, it's gone down, but it will come back? What are you going to do in this case? Quickly tell me. Quickly put it down in your notebook. Okay. Now, further, let's say at that time you waited, you didn't take out your money. Now, 2 months later, another 2 months later, this 80,000 has gone down to 50,000. At this point of time, what are you going to do? You don't have more money, so you can't invest more. Okay, so don't think about that in this particular scenario. Okay, few might say that we'll withdraw. Few might say that we'll take it out. We'll continue staying invested. And let's say another 2 months passed by, and another crash happened, and this 50,000 has gone down to 20,000. What are you going to now do? Are you going to withdraw this money? Are you going to continue, keep it invested? The point being, now I'm sure you have different answers for different scenarios, and everyone might have a different kind of a response to this. Few of your friends might say, "Arey, you should have taken it out at 80,000." Few of your friends might say, no, continue staying invested at 20,000 also. It is going to come back. But let me share my thoughts onto this, right? I think this scenario does not have an answer, and it should not have an answer. Why do I say so? Is because risk appetite is very individualistic. Just like we have different natures about us. Somebody is an extrovert, somebody is an introvert, somebody is a foodie, somebody is into healthy diets, somebody loves exercising, somebody likes to laze out. Similarly, risk appetite is a nature. Somebody is very comfortable even when the 1 lakh rupee drops down to 20,000 rupees. But on the other hand, the other person could get panicked even if 1 lakh drops down to 90,000 rupees. So the inference that the learning from here is risk appetite is individual to you. We need to know what is our risk appetite, right? We're going to learn more about risk appetite as we proceed, because risk appetite cannot be thought about as just a single entity. It has to be clubbed with other things, the other pillars. But I hope you understand what risk appetite means, right? And so let me take you back to the three pillars: the goal, the risk appetite, and time in hand. And let's see how these three things go hand in hand. Goal, risk appetite, time in hand, they go hand in hand. Put this in your brain. Repeat after me. Risk appetite, goal, time in hand, they go hand in hand. Goal, risk appetite, time in hand, they go hand in hand. Now, how do we understand this? So let's take another example. Daughter's education. My daughter is 5 years old as of now. I want to send her abroad for a future study. So when she turns around 20, she'll be, that's the age when she might be ready for her post-graduation. So 15 years from now, in order to send her outside, I need about 1 crore rupees. Okay. Now, my goal is clear. I have 15 years. My goal is my daughter's education. I have 15 years of time in hand. And so the thumb rule says that when you have a long-term goal, your risk appetite is fairly large, fairly high, fairly aggressive. Why so? Because let's say even if we lose some money in between years, maybe in the 5th year, 6th year, 7th year, or even 10th year, we lose some money. There is a probability that if we've taken the right decisions, if we've thought about, we've done the right calculations, our money will come back up. So that means that we've given the markets or the investment a venue enough time to perform well. We have 15 years of time. So even if it goes down in between, it has enough time to come back up. And so in this case, my risk appetite is fairly aggressive. On the other hand, let's say my daughter is now in class 10th and she's just appearing for a boards and then 12th and then 3 years of graduation. So all in all, I have about 4 to 5 years to prepare the corpus for her post graduation. And I have about 70 lakh rupees of money. It's just about 30 lakh rupees more that I need in order to fulfill that goal of 1 crore rupees. So at this point of time, my goal is same. However, my time in hand is reduced to 4 to 5 years. And so my risk appetite goes a little conservative. It goes on the conservative side. Why so? Because I have 70 lakh rupees. I don't want to take any risk with that. I don't want to put 70 lakhs into an investment where maybe I even lose the capital, where I even lose those 70 lakh rupees. I just need to make those 70 into 1 crore, but I don't want to lose a single penny out of those 70 lakh rupees, right? Because I just have 5 years ahead of me. And so in this case, since I have just 5 years in hand, my risk appetite is conservative, is low. And so the thumb rule says, repeat this after me again, the longer the goal, the higher the risk appetite, shorter the goal, smaller is the risk appetite. Repeat after me. Longer the goal, higher is the risk appetite, shorter the goal, lower is my risk appetite. Clear? Now, another important point that I want to add on to this, and write this down and repeat after me once again. Longer the goal, higher the risk appetite, more can I diversify my money into equity investments, into equity instruments. Longer the goal, higher the risk appetite, more I can invest my money into equity instruments. Shorter the goal, lower is the risk appetite, less do I go towards equity instruments, more I go towards fixed income instruments. Why so? As we know, equity markets are volatile. They could go up and down. There's no guarantee of any principal. So only if I have enough time, only if I spend enough time with my equity instruments, can I make some decent profits. In the short term, it gets very tough to make profits out of an equity market, to get returns out of an equity market. Okay. But fixed income, on the other hand, guarantees us a fixed return. And so for my short-term goals, I should prefer them more. And so once again, just so that we are clear, the longer the goal that we have, the longer the time duration, the higher is our risk appetite, the more we can invest towards equity investments, equity instruments. Shorter the goal, lower is the risk appetite, more should be diversified towards fixed income investments. Now, how much exactly to invest? We're going to check that, understand that in the next chapter. If you have any questions, please add them in the comments below and I will make sure we answer them. Do like, share, and subscribe to this channel.